Well, good morning to you. I think we have some sympathy with markets' short-term concerns. You know, stocks have come quite a long way, and clearly we have very high levels of infection, and there is some uncertainty about the scale of the stimulus program out of US policymakers. So we understand market short-term nerves, but you know, it's very difficult to build a very bearish case thereafter. You know, we do have a very clear monetary and fiscal support, and of course we have this vaccine rollout, which does create quite a sound platform for economic recovery later in the year. And those sort of forces mean that despite the market's sort of back and forth, that we remain favourable on equities.
Ben, we had fresh peaks for some markets back in December, in fact into early January here. It does feel like there's a bit of a pause for reflection on just how far we've come here. How concerned or otherwise do we need to be that the VIX is still sitting around, 24 at this point, which perhaps indicates that there's a certain measure of investor caution?
Well, yeah, I mean, I would agree that the sort of confluence of factors could well inject, volatility and see VIX sort of move a bit higher in the short term, as the gains we've seen, unwind a little bit. It's a bit of a reset, a refresh. But that's sort of a natural feature of markets, and with those sort of tremendous tailwinds that I mentioned, the fiscal monetary support and this vaccine rollout, we're not particularly concerned by any short-term market weakness. Recognise it's a bit consensual, though. I mean, that is always a bit of a concern. But ultimately, this weakness should serve as buying opportunities.
Ben, good morning to you. Top drawer US corporate debt now is priced, according to the Moody's screen I'm looking at, around about 2.5%. Last year it was 2.97, we'll call it 3, and historic average is 6.67. I notice at your copy that you do favour corporate credit and, where appropriate, high yield. Do you think you're getting enough bang for your buck, sir?
Well, clearly, yeah. I mean, valuations are looking rich in the corporate credit, and that's why the marginal move, does favour high yield for that extra carry. Relative to history, it does look as though you're taking a bit of a punt there. I understand that, but really, given the backdrop of economic recovery and monetary policy that is firmly accommodative and really no immediate sign of taper, that we're willing to take those higher valuations on the basis that additional carry is not about to be undermined by really any display of economic weakness or tightening in monetary policy.